Good morning and welcome to the weekly trade review. Today is Monday, the 25th of March 2019. We're going to start off with the dollar index. We're going to have FX majors. We're going to look at euro dollar, cable, and dollar yen. Before moving into the equity indices, we're looking at S&Ps and DAX, and looking at commodities also, oil and gold. So let's start with the dollar index, and the weekly chart is really the key chart. In my opinion, we've had this impulsive move lower and the correction higher, natural correction. The correction stalled on a number of occasions around about the 61.8% Fibonacci retracement level. We've got a bit of an ending wedge formation. We're really looking at this upward trending support line, the black line, as the key line in the sand. So we expect a break of here eventually. Last week's almost bullish hammer type candle saw dollar strength towards the end of the week, and so there is potential maybe this week to kick on from here and look for a retest of the 61.8% fib at 97.86. This is a daily chart, and this shows you the three tests of this 97, 68, 70 level, and the reaction here. The support coming in at 95.50 on the dollar index, but as I say, a couple of positive days. Started off slightly negative this morning, but we expect a little bit of support coming in around about the 96.34 level, and as I say, pushed maybe towards the resistance level again, a final retest before the sell-off. Let's take a look at euro dollar now. Again, the weekly chart pretty much summarizes what we've been seeing over the last few months. This sideways, mixed and volatile price action has been very difficult to trade. Obviously, no real trend there, just a sideways channel. Again, last week we saw the initial rally getting sold into and having this shooting star type candle formed, which is negative. But we're looking at the support coming in around about the 61.8% fib. That's 111.80. We're looking to set longs on our short medium term trade idea around these levels for the continuation of the upward move. On a shorter term chart, the euro dollar, this is what we see on the daily picture, looking to sell into rallies around about the 113.60 level for the extended move lower, and we can see this playing out quite nicely this week. So looking at the weekly chart on cable, we can see this reverse head and shoulders formation that price action has broken above the neckline and really had some huge volatility around this break. We can see that we had the bullish outside candle last week looked very positive. Prices last week then retested this this candle and finished higher. So we still remain positive on cable, despite the real mess of a Brexit negotiations that we're seeing. The upside remains quite positive for sterling dollar. If we look at the daily chart, we can see this wedge formation and how prices have reacted from this support line on 3 occasions. So a further drive to the upside is good. There's good potential for that. We'll have a look at dollar yen now, dollar yen weekly chart, and we can see the negative price action over the past few weeks. Although we got a bullish week the previous week and an initial rally last week, prices formed a bearish engulfing candle and have moved lower towards the 110 level. The 110 is obviously, if you look back historically, has been a key pivotal level around here, and 108. So further downside potential here, but we have got a weekly Ichimoku cloud support coming in. It's going to be a tough week for dollar yen. We saw a bit of a shift in sentiment last week with the Fed going from a rate rising potential to rate cutting potential. So the US 10-year yield took a hit and dipped below 2.5%. And with the trade talks between the US and China still looking like an issue, we expect further volatility in dollar yen this week. So let's take a look at the S&P 500 index. Again, pretty much all the time frames show quite interesting price action. We've got the impulsive move lower, correction higher, and this candle last week is a shooting star candle. We managed to take out the highs of the previous week, and even going back, the 28.20 level was key, going back to 5th of November 2018. On 4 or 5 occasions it held prices. We saw the breakthrough and stops hit at 28.60, and then the market closed lower at 28.05, and we can see momentum drop to the downside. So they're quite a negative candle last week. Let's have a look at the daily chart. We saw this bearish engulfing candle on the daily chart after such a positive day the day before. This is all negative for the S&Ps. We expect further downside now, and we're looking to target at least the 27.20 level on the downside, if not further. We'll start to factor in some Fibonacci of the previous up move, even a 38%, which will be a nominal retracement into this band of support, comes in at 26.60. So good potential downside for the S&Ps this week. It's never a straightforward process, but also we wanted to highlight this ending wedge formation that we picked up on. This is bearish. We can see the momentum has been moving lower since prices have been moving higher. So this is bearish divergence. And obviously the break of the upward support here and prices looking to close below here on a day will be further S&P negative. We're seeing a pretty similar picture in the, let's get rid of that, in the DAX, in the German 30 index. Now, this is even clearer in our opinion, and it's something we highlighted towards the end of last week. We've got this head and shoulders formation. We had the break of the neckline, and prices moved aggressively lower into December. Now, we had a throwback from there, and the throwback has come up towards the 11,800 level. Our short-term trade was triggered here and hit its first target this morning. So that was a nice move on that weekly candle. This is a bearish outside candle, again very negative, and sits really nicely with this head and shoulders formation. The throwback has rejected clearly, and we expect further aggressive downside over the coming weeks. Let's have a little look at the daily chart and what we're expecting today. The prices have reacted from 11,276. We expect a small retracement to take place, and looking again to set short around about the between the 114 and 114.85 level for further downside on the intraday charts. So let's take a look at the oil chart. This is the weekly oil. Again, quite a big formation we're looking at. It's a reverse head and shoulders formation, and price action has broken nicely from this neckline, and we're looking for a further drive higher. Currently $60, around about there, is the pivotal area. A break and close above there on a weekly basis would be positive and should see prices extend towards the $67.50, $70 level. If we take a look at the shorter term chart, we're looking for this correction to play out down towards maybe $56.75, $57 before the drive higher that we're expecting after breaking. Obviously, this is the real level to break, 60.40. A break and close above there is very positive for oil. So where does this leave gold? Now, gold is got a lot going on in it. It's obviously the safe haven currency. So generally, when we do have stock markets selling off, which we're expecting over the coming weeks, gold will find support and move higher. So we're seeing price action at the moment. We've got this real psychological support around the $1,300 level. We had a bullish hammer posted on the weekly chart on the 4th of March, and we've had 3 consecutive positive weeks. Let's break it down to the daily chart. There's a bit of a mixed bag going on. Potential for a head and shoulders formation. So this is really the 1320 level is the level to watch. A break close above there, we should see an extended move higher. If it does resist, there's good potential for a pullback down towards the 1250 level. So that's a wrap of the markets this week. Thanks for joining us, and we look forward to sharing our views next week.